Hi, good afternoon. Welcome to today's webinar, our 2021 DCAA update. Sherry Beckert has been providing this webinar or seminar in various forms for probably at least the last 10 years. So we're happy to be here today and share what's going on at DCAA these days. So just to introduce today's panelists, so my name is Susan Moser. I'm the partner and the leader of the firm's government contracting practice. So Sherry Beckert has a special focus in working with government contractors, really of all sizes, shapes, and varieties. So we provide lots of different services to government contractors, including lots of issues dealing with DCAA audits. Along with me today are my colleagues, John Ford. John has been a consultant in our practice for at least a dozen years or so. John has a really interesting and distinguished background as a former procurement attorney and deputy general counsel with DCAA before he joined Sherry Beckert. Also today is Kurt Smith, another member of our government contracting practice. Kurt has been with Sherry Beckert for the last 4 years, and prior to that, he spent I think about a dozen years also with DCAA. So interesting to have their perspectives today. So as I mentioned, we have been doing this DCAA. We usually call it a hot buttons. We actually are calling it an update because we have a lot of information to cover about what's going on at DCAA and some of the new initiatives. So we're not going to focus as much on specific areas of cost as we have in the past, but hopefully you'll find the information useful. We do have a lot of content to get through. We're going to try to stay on track as far as time. We definitely do encourage your questions. We will probably, just in all honesty, not get to our comments, not get to spend any time on the questions today, but don't worry if we don't. Please do send us questions. If we don't address your question during today's broadcast, we will follow up with you directly. And if someone asks a question that we think would be of interest or value to the wider audience, usually it ends up being a blog post. So one thing I did want to point out, in addition to today's webinar, Sherry Beckert, we do put out lots of content and thought leadership in lots of different areas, accounting, audit, tax, but a number of areas specific to the government contracting community. So be sure and look at our website and see we've got a number of other upcoming webinars and events as well. So with that, let's do a quick rundown of what we're going to cover today. So we're going to talk about DCAA has a new contractor survey information. Kurt is going to talk about compensation is always a hot button issue with DCAA. So we're going to spend a little time talking about compensation caps. DCAA does have a number of different systems and processes, so we're going to talk about that a little bit. We're also going to cover some aspects of how DCAA is going to be looking at coronavirus legislation and regulations. That is obviously a topic of keen interest to lots of people. We're going to cover how DCAA is addressing some of those areas. And lastly, John is going to cover a number of recent court cases this past year, mostly with the ASPCA, regarding cost issues that will be of interest to folks to see, you know, how there have been rulings on different areas of cost. So with that, let me just jump into it with Kurt is going to talk about DCAA's contractor information survey.
Hi, Susan. Thank you very much. And I hope everyone listening is off to a good start in the new year. So the DCAA Contractor Information Survey basically is a deeper dive into contractor information, if you will, than DCAA has asked for in the past. They've had other documents such as the internal control questionnaire, the ICQ, that they send out to contractors to try and get some internal control information and contract information. But this new contractor information survey is much more in depth, and it has several purposes. The first of which is to identify potential areas where future audit effort may be warranted. And I know that's a fan favorite with everyone out there. Also to understand the contractor's organizational structure and business, the overall design of the contractor's accounting system, and basic information related to internal control. The no audit procedures or analysis should be performed on the information obtained in the survey. Additionally, the survey does not substitute for DCAA auditors gaining an understanding of relevant internal controls for specific assignments and should not be referenced in audit assignments. DCAA auditors may provide a copy of the survey to contractors to assist them in gathering information. However, DCAA, not the contractor, is responsible for completing the survey. So we would say that it appears to us that DCAA is sending this to all auditees, all contractors that they may audit or have audited. So be prepared if you haven't received it already. You probably will. There are 3 parts to it. Part A assists in understanding the contractor's organizational structure, size, complexity, and business base. Part B assists in understanding the design of the contractor's accounting system and basic information related to internal control. Part C provides for the auditor's identification of potential recommended activities for future planning. So what we've seen so far is DCAA will send the survey to a contractor and ask them to complete parts A and B. They reserve part C for themselves. They may value your feedback in areas you may want them to audit, but I think that's something they will determine on their own. The survey is extensive. I mean that as a joke, by the way. The survey is extensive, and Sherry Beckert is available to assist in completing it as needed.
Thanks. So a couple of points. So DCAA, and we're going to talk about another initiative of DCAA to continue to streamline processes and get information in. So generally, we think that these are good processes. Obviously, you know, they are going to continue to ask for more and more information, and we'll talk a little bit later about, you know, when you push back and when you don't. As it relates to incurred cost submissions, we are going to talk more about that. But recently, DCAA did provide some information in terms of what their priorities are for FY21. They are going to continue to focus on incurred cost submissions. You know, after many years of being behind, according to DCAA, they are current, and so some of these processes will continue to facilitate them staying on top of them. When we get into talking about incurred cost submissions, DCAA is still going to be evaluating all incurred cost submissions for adequacy when they get them within 60 days. Again, we generally think that that's a good thing because if you do have an issue, then you know it up front if it's not adequate. And DCAA does that to also help sort of their clock from ticking. So they are going to be doing that. A couple of other things that I think you can look forward to as it relates to incurred cost submissions. DCAA is going to be focusing on doing a risk-based sampling in terms of which submissions get audited and which don't. They are going to classify submissions into a low, medium, and high risk sampling. And if you don't meet those criteria, then you'll be removed. And so fortunately, hopefully some of you will be lucky enough not to have your submissions audited. Just a couple of other things in terms of what you can expect to see related to DCAA's priorities. So as I mentioned, incurred cost submissions, they are relatively current on that, and they look to continue to do that. But I think as most companies, and certainly a lot of our clients have seen, because they have had the focus on incurred cost submissions, they have not done as many audits in other areas. DCAA has stated that their priorities for this year are to focus on business system audits. That's something that we haven't seen a lot of in the past. If you recall, for those of you, there's 6 business systems. DCAA audits the estimating, material management, and accounting system, and DCMA does the rest. In addition to business systems audits, they're going to focus on truth in negotiations, or TINA audits. So that would be, you know, after you submitted a proposal. And also they're going to be doing real-time material and labor audits CAS compliance audit. So I think we can look forward to DCAA being involved in a number of different areas. So with that, Kurt, you want to talk a little bit about compensation caps?
Yes, and thank you very much. So MRD 20 PSP-004R addresses the changes to contractor employee compensation caps for 2019 and 2020 for contracts awarded after June 24, 2014. The cap changes annually utilizing a formula from the Office of Federal Procurement Policy, and OFPP requires contractors to determine the amount of the increase to the cap each year and to adhere to it. The original cap, $487,000, and formula for annual changes were established in Section 702 of the Bipartisan Budget Act of 2013. The employee compensation cap is described in the FAR cost principles at FAR 31.205-6P and is codified in statutes 10 USC 2324 and 41 USC 4304. The formula for annual update to the cap is the following. Current fiscal year cap equals the prior fiscal year cap times the change in the employment cost index for all workers. There's the full name of the employment cost index. I won't read it, it's quite lengthy, but it's available at the link below. So if we go to the next slide, we can see how the cap is calculated. So for 2020, we calculate the cap to be $555,000, and that's using the prior year cap of $540,000 times the difference or change in the employee cost index. Currently, or in 2020, it was 138.1. Previously, it was 134.4. So you can see the previous years for 2019 and 2018 calculations as well.
So one thing to keep in mind, the compensation cap. So this is designed to be a ceiling for the largest contractors, and so this doesn't mean that every company, no matter the size, can claim this amount as the cap. DCAA obviously has a process that they go through to determine what's reasonable. They look at a database of contractors based on asset size and NAICS code and other things. So this is an area probably still continues to be one of the most commonly disputed items that we get involved with DCAA on is compensation issues. So the cap has been increasing a little bit every year, but still remains to be a hot area in terms of issues especially on incurred cost audits.
The next MRD concerns the contractor submission portal, MRD 20 OTS 005R, and the CSP, as it's known, is a formal electronic method for contractors to submit their certified incurred cost submissions. The goal of the CSP is to provide a single centralized location for all contractors to submit their incurred cost proposals. And the portal functions as a routing tool to electronically deliver the proposal directly to the DCAA secured SharePoint site. Use of the portal is not mandatory, but is highly recommended by the agency. And when an ICS is entered into the portal, it is labeled with the cognizant FAO information based on current information in the DCAA Management Information System, known as DEMIS. The cognizant FAO will receive an email notification in its FAO mailbox that a new updated or withdrawal request has been added. The contractor will receive a confirmation sent to the contractor point of contact listed in the System for Award Management, validating receipt of the proposal submission. Once notified, the cognizant FAO will follow the link provided in the email notification to download the ICS. All incurred cost submissions submitted to the portal are retained. A contractor may withdraw a submission to resubmit it later. However, the current process will retain each submission. The alternative to use of the CSP is for contractors to continue to submit their incurred cost submissions directly to their cognizant field audit office mailbox, which is the way that people have been doing it for many years.
Yeah, so I think a couple points. So again, I think generally this is not that surprising. Certainly, particularly in the COVID environment that we're all in, there DCAA is not visiting contractors' offices and is doing remote auditing, and I think that's generally worked well for companies. So the only thing just to keep in mind is the issue on if you do, it happens fairly often that companies submit their incurred cost submission, and then either they have a prior audit, and if there's some cost that was determined to be unallowable, you want to revise submissions, or you find out you had an error and you need to resubmit. It's no problem to do that as long as they haven't started their audit, but they will keep your old version. So I don't think that's a reason not to use the portal, but just keep that in mind. One of the things that I know Kurt and I have had some discussion about, and we've certainly seen this happening with a number of our clients, is this past year in 2020, based on the NDAA from, I think it was probably the FY18, maybe it was FY19, Congress did basically mandate that DCAA start outsourcing some of their audit requirements. And we don't think that DCAA is particularly happy with this. They, I think, generally view this as a inherently government function, and that DCAA does it best. And so probably not a fan. Nonetheless, a number of contracts were awarded to third-party CPA firms, and we are certainly starting to see a number of audits by firms of incurred cost submissions. And Kurt, I know you've had some experience with a couple of our clients. Just sort of thoughts on what you're seeing.
Well, as we discussed, Susan, these third-party CPA firms conducting these incurred cost submission reviews, they're new to the task. And one of the things that I've heard from contractors currently under audit by these third-party CPA firms is that the third-party CPA firm will ask for great volumes of information even prior to beginning procedures to conduct the audit. And the pushback from the contractor is two things. One, the amount of information you're asking for is so voluminous, it's going to take us some time to get all of that to you. And then number two, do you actually need all of this to conduct a review of our incurred cost submission? So for example, if they ask for information on forward pricing, what does that have to do with my incurred cost submission? And so our advice to contractors that may experience this particular situation is to call attention to the fact that the third-party CPA firm, they understand why they might be asking for it, but they probably don't necessarily need all of this information. It will take quite a while to get it all together. And to suggest to the third-party CPA firm that the firm, if the requirement emerges during the audit, the contractor will provide that information, but they would prefer to wait to see the actual requirement surface. So that's kind of what we're seeing.
Yeah, and I think we're seeing this in a number of different areas of the country as well. And I've been involved with a couple where I was part. They did have an entrance kickoff meeting. They did have a DCAA audit. It was a supervisor on the line, the initial kickoff, and then subsequent to that, the CPA firm did ask for, as Kurt mentioned, just a ton of information. So our message is, don't be afraid to push back or ask questions about what they need particular information for in order to do the audit. And remember, you don't have to create information. You have to make your books available, but you don't have to create information. So just wanted to pass that along. So let's shift gears and talk a little bit about COVID-19 response regulations and how that's going to impact audits and cost submissions.
So DCAA has actually issued an excellent, in my opinion, MRD concerning coronavirus legislation and regulations. I think a lot of people have been waiting for DCAA to put out some guidance regarding this. I'm certain the auditors within DCAA have been wondering about that. The MRD 20 PIC 006R is 14 pages in length. We are going to do sort of we're going to treat some highlights today, but we have an in-depth panel discussion of this same MRD scheduled for March 10th, where we have a group of panelists, subject matter experts, to comment in depth on the various parts of the legislation and the guidance that DCAA is providing. So please tune in for that. But today we're just gonna hit some highlights that we feel are really important. So the MRD provides guidance on legislation enacted in response to the coronavirus national emergency, and covers the CARES Act, the Families First Coronavirus Response Act, and DoD guidance. It provides guidance for auditors concerning audits of incurred costs and forward pricing. The CARES Act, enacted on March 27th, 2020, provides aid and relief in response to the national health emergency. Major sections that could be used by contractors are paid leave reimbursement, Section 3610, Paycheck Protection Program, Sections 1102 and 1106, Employee Retention Credit, Section 2301, and Payroll Taxes Deferral, CARES Act, Section 2302. So starting off with Section 3610, paid leave. This paid leave section allows, at the contracting officer's discretion, but does not fund federal agencies to reimburse contractors at the minimum applicable contract billing rates, not to exceed an average of 40 hours per week. Any paid leave, including sick leave, a contractor provides to keep its employees or subcontractors in a ready state from March 27th through December 11th, 2020, including to protect the life and safety of government and contractor personnel during the health emergency declared for COVID-19.
So a couple things on, a lot of you probably are familiar with Section 3610. There's a lot of coverage, and we've had other previous webinars and postings about this. You know, as Kurt mentioned, it does allow the contracting officer. It's not mandatory, and we've certainly seen plenty of contracts that did not implement Section 3610 into the contract, or maybe it did, but there's not specific funding available. So there's plenty of companies that have had impacts that did not have contracts, or they may just have one contract that did implement this, and other contracts that didn't. So it's not been, you know, provided relief to all contractors for sure.
It's important to note that a contractor may only receive reimbursement if its employees or subcontractor employees cannot perform work on a government-owned, leased, or contractor-owned or leased facility or site approved by the federal government for contract performance due to closures or other restrictions, and are unable to telework because their duties cannot be performed remotely during the public health emergency declared for COVID-19. So in effect, if your employees cannot perform the duties of their jobs remotely, and nor can they report to work physically, then they're eligible for this leave. Paycheck Protection Program, Section 1106. We have Sherry Beckert has a very large Paycheck Protection Program practice, and we will have an expert from that practice in our panel discussion on March 10th. But just today, we're just going to discuss a quick summary. The PP loan can be forgiven if the funds are used for payroll costs, interest on mortgages, rent, and utilities. However, at least 60% of the forgiven amount must have been used for payroll. Borrowers are generally eligible for forgiveness for the costs incurred during the covered period.
I think we've had certainly many companies take advantage of that, the ever-changing rules, which have been a bit of a nightmare for everybody to keep up with. Hence the need to have a more in-depth session again in March.
Okay, Families First Coronavirus Response Act. Section 3102. Employers must provide paid leave from the 11th day forward for employees who take leave to care for a child because of the closure of a school or child care facility due to a declaration made by a federal, state, or local government. Employers may take a 100% credit against payroll taxes for all leave given to employees under Section 3102 and the Family Medical Leave Act, increased by the amount of costs incurred to maintain health plan coverage for those employees. This applies to leave taken prior to December 31, 2020. Section 5102, employees are entitled to a special class of leave related to COVID-19 for personal illness, quarantine, caring for someone who is sick from COVID-19 or caring for minor children. Employers may take a 100% credit against payroll taxes for leave given to employees under 5102, increased by the amount of qualified health plan expenses allocable to the qualified sick leave wages. Any credit in excess of payroll taxes is refundable. And again, this is for leave incurred prior to December 31, 2020.
So I think, as most people know, there was additional legislation passed at the end of the year, which extended and made some additional enhancements. Because most of you are focusing on closing out your books year end and thinking about how you're going to report things for 2020. Our discussion is limited to those things that were in through 2020. And so I think most of you are probably familiar with these, but what does this mean in terms of how do you account and report for this? And that's certainly an area that we've gotten lots of questions, and that's an area that DCA was, I would just say a little bit slow to issue guidance on. And so they finally did in the MRD that Kurt mentioned. But let's just take a little bit of a deeper dive into that.
So what about incurred costs? For example, how should credits resulting from forgiven PPP loans be applied? Forgiven per the guidance in the MRD, forgiven PP loan amounts will be applied as credits under FAR 31.205-5 credits. The credit to contract costs will be in the same manner as the PPP loan proceeds were originally spent. For example, if PPP loan proceeds were used for facility rent as a direct contract expense, the cost of rent against that contract should be credited. For rent in an indirect cost pool, the credit will be applied to the pool. If a PPP loan was expended for direct contract costs and the contract could no longer be credited, that is, it's complete, then the credit will be returned to the government in a manner agreed to with the ACO.
And just from a practical matter, what some companies have done is, if you originally used rent in this example, you can set up a contra account. So if you want to be able to see, the amount of the expenses and then the credit separate, you can set up a same. But basically, it's treating it similarly to how it was originally incurred and reported.
Susan,
Yes.
Kurt, can
Yes.
I add something on that?
Of course.
This is one thing. One thing that's good to know, this is DCAA guidance. To the best of my knowledge, there has been no clause promulgated to be inserted into contracts that would require this type of treatment. So what we're talking about, applying the proceeds from the loan or giving the credit in the same way that the proceeds were expended, that creates some administrative issues for contractors in tracking the funds. Money is fungible. For example, if you got a loan and you put it into your normal bank account, how do you know what the source of the funds is that you use to be making these expenses? So one of the issues that would come up to me is, how do you show how to comply with this guidance and to keep DCA happy? How do you show what the funds were used for if they're put into your normal bank account? To me, one of the issues that would come up is, would you have to create a separate bank account or deposit of your PPP loan so that you can do this tracing?
Yeah, I know, and I think that's a good point, and you're right, there is no specific clause that's incorporated into contracts. I think our PPP group, the general recommendation is that we don't believe that you have to have a separate bank account. And I think, even before DCA issued any MRD, I think we were, essentially relying on the FAR, the credits cost principle in terms of, how companies would account for that. But yeah, good point.
Yeah. Yeah, the FAR, that's one of the other issues, is that the FAR is not designed for this type of a credit, unfortunately.
Yep. I think there's lots of things about the whole COVID-19 that we're not designed for all the things that we're having to deal with right now, right?
Yes.
All right, Kurt.
Okay, so in terms of contract type, so if the contract is cost type and the PP loan is forgiven, will the contract receive a credit due to forgiveness? Maybe. For costs expended on cost type contracts, the contractor will apply the credit to contract costs in the same manner originally spent. However, if a business used PPP loan proceeds to pay employees for work performed for commercial customers on commercial contracts, the forgiven loan amounts used to pay these employees would not create a credit or a refund to the government.
And, I think it's interesting that DCAA even commented on this, because I think, our general recommendation, if you've listened to any of our webinars, and I'm sure we'll cover it again in March, is, really don't recommend that if you have employees that have still been working and performing, certainly on cost type contracts, that you do not include that payroll cost in your, certainly in a loan forgiveness application, but nonetheless, they did issue guidance on that. But I think basically what they're saying is, if you are using this for commercial work, then you don't need to apply the credit back to the government, the government's benefit, if you will.
So what about time and material and fixed price contracts? And John, I'm gonna, after I read this slide, if you want to comment, please do. T&M contracts reference the allowable cost of payment clause 52.216.7 with respect to material. Thus, the material portion of a T&M contract is cost type, and credits would apply. Fixed price contracts, on the other hand, do not include a reference to the allowable cost and payment clause or to the cost principles in FAR 31. Consequently, there is no need to apply credits from PPP loan forgiveness to fixed price government contracts under performance.
Right. Yeah, I agree with that. The key point is that the credits cost principle is in part 31 of the FAR, 31.2. And so what you're primarily looking for is a clause in a contract that incorporates the cost principles into that contract so that the credits cost principle would apply. So the basic rule would be, if you do not have a clause in the contract that incorporates the cost principles, no credit would be due on that contract. So now there can be an exception. Some contracting officer may be smart enough to recognize that problem and may insert a clause in the contract that was homegrown that requires the application of the credit to that particular contract. For example, if you have a fixed price contract where the contractor has been receiving cost-based progress payments, those progress payments are not based on the cost principles, but a contracting officer may put a provision in there that says, if you get a loan if you got reimbursed for costs that were funded using the PPP, this loan forgiveness, that the government would be entitled to a credit against previously paid cost-based progress payments. So you have to look to the terms of the contract to determine whether that contract requires a credit to be given to the government.
Okay. So let's talk about how you're going to show this on your incurred cost submission.
Loan forgiveness may not have been granted in the same accounting period as the loan issuance. Contractors should claim allowable costs in their incurred cost submission in the year the costs were incurred and provide credits to the government for those costs in their incurred cost submission for the period in which the loan was forgiven. For example, a contractor fiscal year 2020 ended on 12/31/2020, and its PPP loan was forgiven in February of 2021. The contractor will claim the incurred costs in its 2020 ICS and apply the credits in its 2021 submission.
So this is really, and I think, this is an area that I think is a little bit confusing to a number of companies, and I think this is going to be the case with most contractors, that they will have received the loans and incurred the costs in 20, and most companies are not getting their forgiveness until 21. And so this is a little bit contrary to how DCA normally looks at things. So if you think about it, normally if you can't claim costs in a period other than what it's related to. So this is a little bit counter to that, but I think it certainly makes sense, and under the circumstances that's how it should be treated.
Classification of COVID-19 leave costs under Section 3610. The Department of Defense recommends Section 3610 paid leave be charged to a newly created cost category, other direct costs COVID-19. Costs from ODC COVID-19 may be allocated to the applicable contracts based on a reasonable allocation as agreed to with the ACO. In some situations, it may be more appropriate to charge these costs to indirect cost pools, overhead, G&A, et cetera. The ACO and the contractor should work together to determine how the cost should be charged to contracts. And Susan, I think from the beginning, we encourage contractors to isolate costs related to COVID-19 in separate general ledger accounts.
Yep. To
create distinct separation in their books of those costs.
Yep.
So right in line with what DoD is recommending.
Yep.
Okay.
So I think next we're going to cover a little bit of, again, part of guidance related to forward pricing. So what we covered so far was how you're going to treat this on your incurred cost submission. Forward pricing, which again, not every contractor has forward pricing proposals. So we'll just cover this quickly. So for those of you that do have forward pricing, things you want to keep in mind in terms of, how 2020 is going to impact forward pricing decisions and how you present information.
Okay, so the impact of CARES Act provisions on forward pricing. The CARES Act extends through December 31, 2020. There is legislation extending portions of it, but we're dealing with 2020 in this particular presentation. And if a contractor's fiscal year 2021 starts prior to December 31, 2020, its fiscal year 2021 indirect rates could be impacted by the CARES Act. So if your contractor fiscal year ends on 9/30, then you're certainly going to be impacted. If costs in fiscal year 2020 are used as part of the basis of estimate for the forward pricing proposal, which is very typical, contractors need to understand how the CARES Act impacted 2020 costs and the effect on future estimates. Should forward pricing estimates consider COVID-19? The circumstances and manner of contractor estimates impacted by COVID-19 will vary. However, the contractor should consider how changes in response to COVID-19 have impacted its future operations. So if COVID-19 has caused a significant drop in the contractor's commercial business, this will impact indirect rate pools and bases. In addition, if the contractor's workforce on government contracts is affected by COVID-19, this should also be reflected in estimates.
I think, pretty intuitive, so nothing particularly earth-shattering, I think, in that guidance.
Exactly. So what is the impact to existing forward pricing rates finalized prior to COVID-19? Contractors must assess materiality of the impact on existing approved rates, forward pricing rate agreements, or forward pricing rate recommendations. Rates require updates to remain current, accurate, and complete as changes occur at the contractor. If a prior audit opinion, FPRA or FPRR, does not consider the potential impact of COVID-19 and the impact is determined to be significant, action may be required in the form of updating those rates to protect the government's interest.
And, they did issue guidance on this, but again, I think this is, somewhat to be expected, just as contractors have any impact or change in their, cost situation or budgets or forecasting. They, need to look at, evaluate their forward pricing proposals or rate agreements and see if changes are warranted. I think, obviously goes without saying that 2020 was an unprecedented year, and companies have been impacted in ways that no one certainly anticipated. So to the extent that companies do, you should look at revising that. So what we're going to do for the last number of minutes is John is going to cover some recent court cases, and the reason that these cases are going to be discussed is, well, it's always interesting to hear about court cases, but what's good to think about when you hear some of this is, how do these decisions impact how, the government in general, auditors or otherwise, are going to interpret and treat, similar situations. So it's always good to know, kind of what the court is doing, because that really has bearing on how things are handled going forward. So, John.
All right, thanks, Susan. Well, the first case we're talking about is from the ASPCA involving a contractor called Double Shot. What this is a statute of limitations decision. As we can see, what happened here, Double Shot, or government, issued a claim against Double Shot in June of 2018, asserting that Double Shot owed the government money, $800,000, for contracts performed back in 2009, 2010. These were cost plus contracts, and the government is contending that Double Shot was overpaid. What Double Shot started off doing, they tried to get the claim dismissed, saying it was filed too late. And the basis for this was that DCAA submitted a flash report in April of 2011, which was more than 7 years prior to the date that the final decision was issued. That flash report commented on Double Shot's accounting procedures, and particularly its labor accounting procedures, and basically questioned cost, or alerted the government that there were issues with Double Shot's labor cost, and that the government could not rely on the data that Double Shot had to be supporting the claims for labor. So following that flash report, DCAA issued an audit report in June of 2017, questioning various costs, primarily labor. So that was the basis for Double Shot's claim, that the claim by the government was submitted more than 6 years after the claim accrued. Double Shot saying the claim accrued back in 2011 when the flash report was issued. The board did not, so Double Shot filed for a summary judgment motion before the board, but the board denied Double Shot's motion because Double Shot had submitted new data to DCAA between the time that the flash report was issued and the audit report was issued. But Double Shot was upset by this and filed a request for reconsideration. The board denied reconsideration of the motion that Double Shot had filed, but the board sort of backed off on its position in regard to whether the statute of limitations had been breached by the government. What the board held on reconsideration was that, wait a minute, although there was a flash report that talked about labor and record keeping for labor, and there was an audit report that contained similar language, we, the board, don't know what documents DCA actually relied on for the flash report and for the audit report. So what the board backed off from the original decisions that basically hinted to double shot. Once we see all of these documents, we may be able to come to a decision that would be sustaining your contention or your defense that the claim by the government was filed too late, more than 6 years after the claim accrued, which would have been back in 2011 instead of 2017 when the audit report was issued. So the key takeaway from this is that these, again, emphasizing the point, whether the statute of limitations has been breached or exceeded by the government or a contractor is a question of fact, and you got to consider all the facts in making that determination. So apparently the board's going to look behind audit reports or flash reports to see when a government claim may have accrued.
And I think that that's really significant because the statute of limitations issues, those are real issues. And I think one thing, you know, just for companies to think about is really documenting your timelines on all these different things, because you know, the statute of limitations is real, but you know, documentation and you know, being able to defend what happened when is certainly critical to that.
Okay, DynCorp, this was an interesting case in a way. It involved the disallowance of severance payments made to DynCorp's former CEO. DynCorp had agreed in an employment agreement with the CEO that in case he was terminated, that DynCorp would pay him a severance payment of 2 times his annual salary and bonuses, and that these payments would be made over a 3-year period. DCAA was, the total amount of the payments to be paid, as we see here, was $9.2 million less tax withholdings. DCAA questioned this amount, using as its guide these compensation caps in 31205-6P that Kurt talked about a little earlier. And what DCAA was saying is, since the severance payments were based on wages and bonuses, and salary, wages, and bonuses are included within the salary cap, that anything that went above the salary cap and computing the severance payments would be unreasonable. So what DCAA did was to look at the salary cap that was in effect when the agreement was entered into. So that's another interesting point here. And what DCAA did was question 7.8 out of that 9.2 million that DynCorp had agreed to pay. So the board, in looking at the case, an interesting decision or conclusion reached by the board was that severance payments are not compensation, which I think would be interesting to know for the FAR Council, since they include severance payments in the compensation cost principle. But the board did sustain the challenge to the severance payments on reasonableness grounds. And the particular factor that the board relied on under the reasonableness cost principle was the contractor's responsibility to the government and the public. In that regard, what the board said was that contractors have an obligation to the government and the public not to claim cost in excess, or compensation cost in excess of the compensation ceiling. So having severance payments that exceeded the compensation ceiling was an unreasonable amount of money for the government to be paying in regard to severance payments. Now, what I found very interesting was the statement by the board, which is captured in the last sentence on this slide, which is talking about the compensation, the severance payments being unreasonable, where the board said this conclusion is just common sense. There's nothing magic about a severance payment calculation that converts unallowable salary into allowable severance payments. So this was a unique application of the compensation caps in regard to determining reasonable severance for a dismissed CEO.
Interesting. So
Yeah.
I think the next, for the sake of time, so the next case deals with pension, and we've got several other cases to cover. And I know, as I suspected, we're going to be running short on time. So I think what we'll do, John, is we'll skip over this case. I should have mentioned in the beginning, if you are listening to this today, we will provide you with a copy of the slides, and on our website in another week or so, the webinar will be available for download. So when you get the slides, you can read about this case, but I think for the sake of time, we will skip over it since pension doesn't apply to that many companies.
Yeah, can I make just one point to point out one thing on the first slide? Although this is a CAS case, there are cost principles that do incorporate the CAS into the contract. So even if you do not have CAS covered contracts, if you do have cost reimbursement contracts, this case would be applicable to those cost reimbursement contracts that are not CAS covered by application of the compensation cost principle at 2056J3B.
Okay. All right. Let's go to the next one.
Okay. This was in case dealing with expressly unallowable costs, and I'll try and get through this. This was also a statute of limitations case, and the contractor was arguing that the government's claim accrued when the contractor submitted its incurred cost proposals in earlier years, but the board rejected this statute of limitations argument primarily because the incurred cost proposals did not contain sufficient information to let DCAA or the government know that it had a claim against the contractor. Now, getting to the merits of the case, primarily this was patent legal costs relating to patents. Now, what we had here were 4 SBIR contracts that had a specific clause in the contracts that related to patents. But it seems like the DCMA and DCAA did not read that clause or give a close reading to the patent cost principle and just assume that all patent costs were expressly unallowable. And what the board held was they denied the government's motion for summary judgment on this, which would mean that the government wins. And what the board observed was that in the board's initial determination that the cost incurred by the contractor would be allowable cost based upon the patent cost principle and the patent clause that's in the SBIR contracts. And this demonstrates the principle that one of the elements of cost allowability is the terms of the contract. So you've got to read your contracts to determine if there are any cost allowability provisions that are in the contract in addition to the cost principles.
Okay. And
Okay.
the last case we're going to cover quickly because we are running out of time.
Right. And Reader's Digest version of this was another statute of limitations case. Contractor had a contract to do work in Afghanistan. completed the contract or contracts and submitted an REA for government cause delay in performance of the contract. The government and contractor were never able to come to an agreement on the REA. The contractor then filed a claim to recover the cost that it had incurred, that it claimed in the REA. The contracting officer denied the claim, saying that it was submitted too late. And the contractor said, whoa, wait a minute. I've got this REA out here, and I submitted this certification that was required by the DFARS for REAs. Excuse me. So the REA should be considered a claim. And the board said, no, the certification you provided did not request a contracting officer's decision. So it was not a certification under the CDA, and you are too late. So the lesson to be learned from this is that submission of an REA and negotiation of the REA does not toll the running of the statute of limitations in regard to submitting a claim. So you've got to file your claim within that 6-year period, regardless of the conduct of negotiations in regard to an REA that would be the same subject as the claim.
I think it's interesting that several of these big cases this past year did all relate to statute of limitations. So again, that continues to be an area of concern, both on the government's part and the contractor's part. So I think good to review those. So as we suspected, we knew we had a lot to cover and in a short amount of time. So we will end with that. As I mentioned, I do see a few questions in here. So we will follow up with folks directly to answer their questions. All of our contact information is here. Please don't hesitate to reach out to any of us if we can be of assistance to you. And as Kurt mentioned, we do have a number of upcoming webinars, seminars on matters of interest to government contractors, including quite a bit that we have issued and spoken about related to CMMC, which is another, obviously, a hot topic. So we hope that you all found this information of value to you. And again, please don't hesitate to reach out to us if we can be of assistance. Thank you very much. Goodbye.